Some people grind their asses off for years building wealth, and then everything just stops. Not because they stop earning, not because the market tanks, but because they hit this weird psychological shift they never saw coming. A shift that changes how they think, how they spend, how they invest, and they don't even realize it's happening. And that shift happens at $250,000. It's a number that feels like you're winning, but it's actually a trap if you don't understand what's really going on. My name is Dobers, and I think about this shit way too much. Why some people become millionaires while others with the same income just stay stuck in the same place forever. Today we're talking about what I call the $250,000 rule. And some of this is going to completely change how you think about building wealth. Most people think wealth building is just linear math. Save 10 grand, you're 10 grand richer. Save 50 grand, you're 50 grand richer. Easy, right? But here's what nobody tells you. There are specific dollar amounts where everything changes, where the psychology of money shifts so hard that your entire relationship with wealth gets flipped upside down. $250,000 is one of those numbers, and it might be the most dangerous one. Before we get into why this number matters so much, let me tell you something that'll probably surprise you. The average American will earn over $2 million during their working life. $2 million. Yet somehow most people retire with less than 100 grand saved. Where the hell does it all go? It's not just spending or market crashes. It's psychological traps that kick in at specific wealth levels, and the biggest trap happens right around $250,000. Here's the thing about hitting $250,000 in investments. It's the moment wealth stops feeling like some abstract concept and starts feeling real. This is when your money starts moving faster than you do. One good market day can make you more than your entire weekly paycheck. One great month can generate more passive income than some people make working full-time. But here's where it gets dangerous. It's also the point where one wrong decision can erase years of careful progress. Think about it. When you've got $5,000 invested and the market drops 10%, you lose $500. Sucks, but it's not going to ruin your life. When you've got 250 grand invested, that same 10% drop costs you $25,000. That's more than most Americans save in an entire year. Suddenly the stakes aren't just higher, they're in a completely different fucking universe. But the real danger of hitting 250 grand isn't the potential losses. It's something way more subtle and way more destructive. It's what happens inside your head. There's this psychological thing that kicks in around this level. I call it the illusion of arrival. You start seeing your portfolio jump $5,000 in a single day, and suddenly your brain starts playing tricks on you. You start thinking you've made it. You start feeling wealthy. And that feeling, that dangerous, intoxicating feeling, is where most people's wealth building just stops dead. Let me show you what this looks like. You check your account on a Tuesday morning, and boom, you're up $8,000 from yesterday. Your brain immediately starts doing math. 8 grand in one day, that's more than you used to make in a month at your first job. Clearly you're doing something right. Clearly you deserve to celebrate. Maybe it's time for that vacation you've been putting off. Maybe you should finally upgrade your car. After all, you're basically rich now, right? Wrong. Dead fucking wrong. And this is where the $250,000 rule becomes ruthless. Here's what's actually happening at $250,000 that most people don't get. You're not rich. You're not even close to rich. What you are is dangerous. Dangerous to yourself, dangerous to your future, and dangerous to the wealth you've worked so hard to build. You've got just enough money to make really expensive mistakes, but not enough money to recover from them quickly. That $8,000 gain I mentioned, it's unrealized. It exists only on paper, only in your brokerage account. It can disappear tomorrow or next week just as fast as it showed up. But that $10,000 vacation you're thinking about, that's real. That's permanent. And that can set you back months or even years. This is what I call the dangerous illusion at $250,000. The illusion of wealth before you're actually wealthy. And it destroys more financial futures than market crashes, recessions, and bad investment advice combined. But wait, it gets worse. The psychological traps don't stop at feeling wealthy before you actually are. There's another monster lurking at the $250,000 mark, and this one's even more destructive. I call it the overconfidence monster. And it feeds on something psychologists call the Dunning-Kruger effect. Here's how it works. You've managed to stack up $250,000 through some combination of saving, investing, and maybe a little market luck. Your portfolio's grown steadily for years. You've weathered a few downturns and come out ahead. You start thinking you understand how this whole thing works. You start believing you're some kind of investing genius. This is when people go completely off the rails. This is when conservative index fund investors suddenly think they can pick individual stocks. This is when people start dabbling in options trading, chasing meme stocks, or throwing money at speculative real estate deals. This is when the phrase, "I can afford to lose this," becomes the most expensive sentence in the English language. The cruel irony is that at $250,000, you finally have enough money to make the kind of mistakes that can set you back years. You can afford to lose 10 grand on a bad stock pick. You can afford to gamble 20 grand on crypto. You can afford to invest 50 grand in your buddy's restaurant idea. The problem is that affording to lose money and being able to afford losing money are two completely different things. One bad decision at this level can delete 2 to 5 years of compounding growth. Think about that. 5 years of disciplined saving, 5 years of consistent investing, 5 years of delayed gratification, all wiped out because you thought you were smarter than the market. And here's the kicker. The bigger your account gets, the more confident you become, and the bigger the mistakes you're willing to make. It's like psychological quicksand. The more you struggle, the deeper you sink. But there's yet another trap, waiting at $250,000. And this one might be the quietest killer of all. It's what I call the comparison trap. Here's how it works. You finally reach $250,000, and for a brief moment, you feel successful. You feel accomplished. You look around at your peers who are still living paycheck to paycheck, and you feel pretty damn good about yourself. Then something happens that changes everything. You meet someone at a networking event who mentions they have 500 grand invested. Suddenly, your 250 grand doesn't feel so impressive anymore. Then you read an article about someone your age who's already hit 800 grand. Now you feel behind. Then you see a social media post from someone flaunting their $2 million portfolio, and suddenly you feel like a complete failure. This is where people sabotage their own progress trying to catch up. They abandon their conservative steady approach and start chasing higher returns. They increase their risk beyond rational limits. They start making desperate moves to close the gap between where they are and where they think they should be. The comparison trap is particularly vicious because it never ends. There will always be someone with more money than you. Always. Even billionaires compare themselves to other billionaires. The moment you start measuring your success against someone else's highlight reel is the moment you stop appreciating how far you've actually come. But here's what makes the comparison trap so brutal at $250,000. It's not just about feeling bad, it's about the specific financial behaviors it triggers at this exact level. When you have 50 grand invested, comparing yourself to someone with $1 million doesn't really change your strategy. You're still focused on the basics, still saving what you can, still learning the fundamentals. But at 250 grand, that's when you have just enough money to make really stupid decisions in the name of catching up. This is when people start leveraging their portfolios. This is when they take out home equity loans to invest in the stock market. This is when they convince themselves that taking on debt to invest is just being strategic. After all, if the market returns 10% and you can borrow at 6%, that's free money, right? Wrong. That's how you turn a temporary setback into a permanent catastrophe. I've seen people with solid $250,000 portfolios completely destroy themselves trying to speed things up. They'll see someone bragging about making 6 figures in crypto and decide they need to allocate 50 grand to digital assets. They'll hear about someone doubling their money in real estate and suddenly think they need to become landlords. They'll read about day traders making thousands per week and decide their boring index funds aren't cutting it anymore. The brutal truth is that at $250,000, you're at the most dangerous point in your entire wealth building journey. You've got enough money to hurt yourself, but not enough to protect yourself from your own bad decisions. But let's talk about something that might surprise you. Something that financial advisors and wealth building gurus rarely mention because it doesn't sell courses or generate fees. The real secret about hitting $250,000 isn't about what you should start doing differently, it's about what you should absolutely not do. Here's the thing, nobody tells you about crossing the $250,000 threshold. You don't need to get fancy. You don't need to start picking individual stocks. You don't need to diversify into REITs or commodity funds or international emerging markets. You don't need to hire a financial advisor who's going to charge you 1% annually to tell you to do exactly what you were already doing. What you need is something that sounds almost boring. You need to keep doing exactly what got you to 250 grand in the first place. But here's why that's so hard. Continuing to do the same boring thing when your account's jumping around by thousands of dollars every day feels like you're not maximizing your potential. It feels like you're leaving money on the table. Your brain starts playing this cruel game where it shows you all the opportunities you're supposedly missing. Look at that stock that went up 300% last year. Look at that real estate deal that would have doubled your money. Look at that crypto that made people millionaires overnight. Surely with your $250,000 foundation, you could afford to take some of those risks now. This is the exact moment where discipline becomes more valuable than intelligence. This is where the ability to ignore noise becomes more important than the ability to analyze opportunities. This is where boring becomes beautiful. Because here's what actually happens when you stay boring at $250,000. Something magical occurs that most people never get to experience because they sabotage themselves first. Your money starts working harder than you do. Let me show you some math that'll completely change how you think about this milestone. If you got $250,000 invested, earning 8% annually, that's $20,000 in growth per year. $20,000. That's more than some people save in their entire lifetime. And your money's generating that much every single year without you lifting a finger. But it gets better. Because of compound interest, that $20,000 in growth starts earning its own returns. Next year, you're not just earning 8% on $250,000. You're earning 8% on $270,000. The year after that, 8% on over $290,000. The growth starts snowballing in ways that'll genuinely shock you if you've never seen it happen before. Here's the part that'll blow your mind. From $250,000 to $500,000 takes about half the time it took you to get from 0 to $250,000. Read that again. The second $250,000 comes twice as fast as the first. And the $250,000 after that, even faster. This is why I call $250,000 the point of no return. Not because you can't lose money from here, but because if you can resist the psychological traps at this level, building serious wealth becomes almost inevitable. Your money develops momentum that becomes increasingly difficult to stop. But there's something else that happens at $250,000 that nobody talks about. Something that has nothing to do with compound interest or market returns. You gain options. When you've got $250,000 invested, you're no longer trapped by your paycheck the way most people are. You can't retire on it, obviously, but you can make career moves that people living paycheck to paycheck simply can't consider. You can take a temporary pay cut to join a startup with equity upside. You can negotiate more aggressively with your current employer because walking away isn't financial suicide. You can relocate for better opportunities without worrying about covering moving expenses. This is what I call the hidden power of $250,000. It's not just about the money itself. It's about the freedom that money provides to make decisions based on opportunity rather than desperation. And these decisions, these career moves and calculated risks that become possible at this wealth level, often accelerate your income growth far beyond what your investments alone could achieve. Think about this for a second. You've spent years building discipline, learning to live below your means, consistently investing. You've developed what most people never develop, the ability to delay gratification. But now, ironically, that discipline becomes harder to maintain when the rewards get bigger. It's like learning to drive in a Honda Civic and then being handed the keys to a Ferrari. Same basic skills, completely different stakes. This is why so many people stumble right at the $250,000 mark. They mistake having options for having unlimited options. They confuse being strategic with being reckless. They think because they can afford to lose $10,000, they should be willing to risk it. But here's the brutal truth about this wealth level. Every dollar you lose now costs you roughly $4 in future wealth due to compound interest. That $10,000 mistake today becomes a $40,000 mistake 20 years from now. Let me share something that might sound counterintuitive. The secret to navigating the $250,000 threshold isn't learning new strategies. It's unlearning the need to be clever. The biggest winners at this level are often the most boring people you'd never want to sit next to at a dinner party. They keep buying the same index funds, keep living in the same reasonable house, keep driving the same reliable car, and keep doing the same boring shit that got them here in the first place. But staying boring requires something that's surprisingly difficult when your net worth is jumping around by thousands of dollars every month. It requires ignoring the voice in your head that says you're not maximizing your potential. It requires accepting that slow and steady really does win the race, even when the race feels like it should be more exciting by now. Here's where the math gets really interesting, and this will fundamentally change how you think about the $250,000 milestone. Most people think of 250 grand as being a quarter of the way to $1 million, but compound interest doesn't work like that. In terms of time, 250 grand is actually halfway to becoming a millionaire. Let me break this down because the numbers are genuinely mind-blowing. If you're consistently investing $10,000 per year at 8% returns, it takes about 13.8 years to reach your first $250,000. But here's the kicker, it takes roughly the same amount of time, another 13.8 years, to go from $250,000 to $1 million. The same amount of time for 3 times as much money. This is the moment compound interest stops whispering and starts shouting. Your money has finally built enough momentum to roll downhill without you constantly pushing the boulder uphill. This is why Charlie Munger famously said, the first 100 grand is the hardest. But the principle applies even more dramatically at 250 grand. But knowing this creates its own psychological trap. When you realize you're halfway to millionaire status, it can trigger what I call acceleration anxiety. You start thinking there must be something you can do to speed up the process. Maybe you should increase your risk tolerance. Maybe you should start picking individual stocks. Maybe you should leverage your portfolio with some borrowed money to really supercharge your returns. This is exactly backwards thinking. At 250 grand, your job isn't to accelerate the process. Your job is to not screw it up. Your money has reached escape velocity. It's generating its own momentum. The worst thing you can do is interfere with that momentum by getting creative. I want to share something that most financial advisors won't tell you because it doesn't sell their services. The difference between people who build lasting wealth and those who sabotage themselves at this level often comes down to 3 simple rules. Not complicated strategies, not sophisticated tactics, not insider knowledge. 3 boring, unglamorous rules that separate millionaires from everyone else. So there you have it. The $250,000 rule isn't about what you should do when you hit this milestone. It's about what you absolutely shouldn't do. Stay boring, stay disciplined, and let compound interest do what it does best. Because the hardest part wasn't getting to 250 grand. The hardest part is not destroying it on your way to becoming a millionaire.